Today, we are going to analyze a fast-growing, great dividend payer company, and it's also in my investment portfolio. So I'm super excited doing this video. And this company is Broadcom, ticker symbol AVGO. And if you would like to start investing, feel free to use the link in my description. I also have some discounts there to check it out. And if you would like to see more analysis of companies, subscribe to my channel and comment the next stock I should analyze in the video. So, as you can see, I have loaded up my Google Sheets and put the ticker symbol AVGO into it, and all the datas are loading in. And if we see the current PE ratio of the company is 65, so we can see that from a PE perspective, it's quite heavily priced in. Also, the company is having a very, very healthy 24% profit margin. This is net margin, so we are going to look at it more detailed. The current ratio, which is the current assets / the current liabilities, are 1.25, so super healthy or healthy. Debt to equity is about 1, which can be acceptable in the sense of it's a fast-growing company, so it might need debt to finance itself. Price to free cash flow is much better than the PE ratio. You will get 38 in that sense, and cash per debt is also, it's all right. Let's just say that. And then dividend, if we see, dividend is 3.32% dividend current yield, and the payout ratio is about 56%. This is quite okay-ish if you are looking for a company that is growing and also paying a nice dividend. Then AVGO can be an option. We can see that the earnings per share is going to grow by 27% year over year as these estimates. And if we look at the return on equity, 22%, these are all fine, and let's say it's green light. If we want to look at a little bit the forward datas, then we can see that the price to earnings ratio forward is 25. So you can see that their profits estimates are increasing. The PEG ratio is 1.75. So you can sort of say it has a nice growth, but a nice price. So it will all depend on how they can actually rely on their forecasts. And if you look at just a little bit on their growth, you can see that EBITDA is 22%, EPS growth is 24%. So the company is getting more and more profitable. If you want to have a little look into the dividends, let me just add a few lines here. That's why it's not loading. And then you can see that very nicely and steadily they have been increasing their dividend cash payments, which is great for long-term investors in that sense. And also, if you look at the analyst opinions, the stock should be trading at a higher level than the current price target. I would say, look, you should always heavily judge what the analysts are saying. As you can see, most of them are in the buy or strong buy range. I am very cautious about this. And if we want to have a quick look about their historical ratios, we can see that the PE is quite high historically. So it was in the from 2019, it was never at the current point. I bought in the company around the 70s, so I had realized very great profits. Slowly I have been actually selling my shares in the company. So if we want to look at even that how is the company going to grow, we should look more detailed. And this is Y Sheets, where you can also get a discount if you check my link in the description. It's a super cheap, super cool product where you can analyze companies very simply, and you can, even if you just spot one mistake in your investment life, the $60 you are going to spend for yearly costs of this program is going to be paying off a lot. So if we check the gross profits of the company and the gross margin, we can see it's actually a very, very healthy level. And if we look at the net margin, we have seeing it has been shrinking. But I would say actually it is getting more normalized, because if we look at the historical numbers, it should be around the 20s, and the 20 net margin is absolutely great for a company in the size of this one. And if you see, their free cash flow growth is just amazing. So if I would just look at the free cash flow growth, it is super simply forecastable, because the company has been increasing from year to year. So in this way, we can do a discounted cash flow very, very simple. And this is what we actually going to do. So if we do a simplified discounted cash flow model, put the cash flows, the free cash flows into the table. Of course, we don't have the final 2024 numbers, but we are going to use the TTM as it's still growing. We can see that the average growth is about 12%. I'm going to forecast 9, since there should be some healthy level of margin. And also, don't forget, we have to keep this for the next 10 years. So there has to be a growth level where we are actually very, very fine with the number there. So even 9 could be a little higher. And then we are going to use a discount rate, which is calculated from the WACC. And the WACC is between the 8.7 and 11.6. And we are going to use the 10.7 as somewhere in the middle as a defensive margin for the 2%, as you can see here. And then we are going to get everything automatically that the discounted price per share is about $70. And I think this is a moderate calculation, a very simplified moderate calculation. And if you see other analysts more conservative calculations, you can say that sort of it is overpriced. The current price is, as you can see, super overpriced. So in this sense, we can say the company is currently overpriced. But as you know, sometimes the market is overpricing some companies, and also it is pricing in futures growth, and the company has some great growth potential. Although I'm not buying more stocks, I am rather restructuring my portfolio and selling in profits. And then, of course, since I'm a long-term investor and it's a great company, I'm going to hold my position in a more healthy way in terms of the portfolio allocation. If you look at the 1 year total return versus total return, we are going to benchmark it with the S&P 500. We can actually see that the company has been doing wonderfully. It has a much better return in terms of the S&P 500. And if you look at the 5-year terms, then we can see that the company was a great investment point from the 2020s. And in regards of the 10 years, we can see that over time it has truly more performed. So it has performed much well than the S&P 500. And also the dividends is something very attractive as the company is keep growing it. So I hope this was a little help for you. And also, if you want to support my work, I would appreciate if you subscribe. Feel free to let me know the next company to be analyzed. Check out the links in the description and see you in the next one. Have a good day to you. Goodbye.